Hello, ladies and gentlemen. A warm welcome to all of you on today's session, Saving Tax the ELSS Way, presented to you in association with Mirae Asset Mutual Fund. I'm Manisha Nair Dhawan, your host for the day. Now, creating long term wealth and lowering tax liability are the things that every Indian investor looks for. With equity markets expected to touch new highs in FY 24-25, equity linked savings schemes ELSS is an attractive investment avenue for those looking for wealth creation along with some tax saving. But does such high equity exposure make it a high risk investment? Is there a lock-in period? And what happens if I need my funds before the lock-in period gets over? In today's discussion, we have two distinguished speakers, Mr. Shrinivas Khanolkar, Head Products, Marketing and Corporate Communications, Mirae Asset Investment Managers India Private Limited, and Mr. Rushabh Shah, founder of Midas Finance, who will answer these queries and many more to bring us a wealth of expertise on the subject of ELSS funds. Their insights and perspectives will help us to make sound financial decisions. So, without any further ado, let's get started with the discussion. A warm welcome to both of you, Rushabh and Srinivas. Thank you so much for joining us.
Thank you for having us. Yeah.
Thanks, Anisha. Thanks for welcoming us to this special one on ELSS. Of course, the season starts now for investors to plan, so great time to chat on those grounds.
Yes, yes, all those investments must be made before March 31st. So, Srinivas, let me start with you. Just to set the context with the background, what exactly is equity linked savings scheme and how is it different from any other mutual fund scheme?
Well, that's a great question up front. As SEBI has now introduced categorization of schemes, we have multiple categories which have been established, and each fund gets slotted to that. In fact, now there's a mandate that the scheme has to mimic the name of the category. So, just to give an example, for example, if the fund is under large cap category, then the fund name should also be XYAMC Large Cap Fund. And if it's ELSS, which is Equity Linked Savings Scheme, then the fund name would also be XYZAMC ELSS Fund or ELSS Tax Saving Fund. So that's a new abbreviation which has got added, which actually simplifies to the investors that this is what the scheme is all about. Now, the government in 2005 notified there are rules as to how ELSS is brought forward, which means that at least 80% of the underlying investments of the scheme has to be invested in equity and also as notified by the Ministry of Finance. So you cannot just go out and do as you like to do. It's not like any other, like there's a category called flexi cap where for equity taxation you need to be invested minimum 65% in equity, but there you can have the rest in debt or any other instruments. But here 80% has to be as per the notified guidelines. So that is one where this category stands out as compared to all other categories where they have different rules, but this is the only category which is straight away, it actually finds its placed in Ministry of Finance documents. So that way, this is a category which brings Indian investors to sort of investing for helping their tax savings. And ELSS, again, very, very interesting category where investors have been investing over a period of time to not just save tax, which is their prime objective, but over a period of time, they've been able to sort of make a lot of wealth out of it. So it solves two purposes. And of course, I think during the course, we'll discuss about the rest of the details about this product. But largely, ELSS category is what I just mentioned.
Right, Srinivas, there are many mutual funds which invest in equities. How is an ELSS different from those mutual funds, and why isn't there a tax saving there?
Yeah, so of course, there are three types of tax saving. One is your long-term capital gains, one is your short-term capital gains, and then there is something which qualifies under your ATC tax exemptions. This specific product or category of product falls under the exemption category, whereas your long term and short term will be available for the rest of the categories. So here only the long term will apply because there's a lock in for 3 years. So after 3 years, your value will be decided in terms of whether you have any capital gains or not in long term, and that too again if it is more than 1 lakh rupee. But exemption wise, this is the only category which gets you an exemption straight away and not just the capital gains. So that's an add-on.
All right. Rushabh, as an investor, how can I evaluate the performance of ELSS fund when I'm looking to invest in? Because not all mutual funds are same, and not all ESS funds will also be the same, right? One will do better than the others. Are there any benchmarks that are commonly used?
Okay. So first of all, thank you, Anisha, for having me on this particular section. Where just to tell you that mutual funds is a very interesting instrument through which we invest into Indian equity markets. Out of which ELSS forms a very important part because over here we also save tax and simultaneously make returns. Right. When it comes to evaluating each of these mutual funds, there are three major parameters when you can that you can consider while comparing the ELSS funds. The first being the strategy of the fund, whether the fund manager is investing more towards large cap or more towards small and mid caps. So that decides the return and risk taken and towards the fund. The second will be the performance of the fund, which can be monitored using two major ratios. One being the Sharpe ratio, which talks about risk adjusted return. Higher the Sharpe ratio, the better for the fund. And the second will be standard deviation ratio, which talks about how much the fund is volatile over the year. The lower the standard deviation ratio, that is better for the fund. And the third and the most important way a lot of people which prefer to use is looking at the past performance. But when you're looking at the past performance, you should generally look at 5 year rolling return because that gives you a holistic idea about how the fund has performed over the entire tenure rather than just looking at 6 months or a year in on the high side. So that will be my take on how to evaluate a fund. But also when it comes to having a benchmark, BSC 500 is an amazing benchmark to have for this fund because most of the funds are using a multi asset exposure, which means a large cap, mid cap, and a small cap. So BSC 500 is a good benchmark to have when you're evaluating an ELSS fund.
So you mean to say that the ELSS fund that you pick should show returns comparable, same as, or more than what returns over 5 years the BSE 500 is shown, right?
Yes. So the idea, the answer to this question will also depend on the strategy of the fund, as we rightly said. Uh, what is the exposure that the fund manager is taking? If he's having more of a large cap exposure compared to the BSC 500, then the fund should somewhere perform in tandem or a little lesser than that of a benchmark. But if the fund manager is having the same exposure that of a BSC 500 index, then we can expect in line or a higher rate of return.
All right. Srinivas, the government gives you some exemption limit. Some of your income, if you invest in some instruments, that will be exempt from tax under 80C. So how does ELSS compare with other tax saving instruments when it comes to investment option?
Yeah, again, ATC is a broad basket. There are multiple um, avenues where the investor can actually go and invest. Part of which is already taken care for a lot of people through their salary, right? A percentage of that goes to their long-term savings, like PF and pension and all of that. And a lot of people also do deposits, uh, but that again has to happen for 5 years, so that there is tax exemption to that accord. But what is very interesting and how we are finding that people are actually taking advantage of the ELSS is I'll just give you one data point we were looking at, that in in say March 2020, average ticket size for an investor in the ELSS segment was about 1,20,000. Now this is uh, assets under management divided by the number of folios which are there as on that date. Today, it stands to about it's grown from there to close to about 1 lakh 55 1 lakh sorry, it's grown from 60,000 in March 20 to 1 lakh 21,000 now. So that is your assets under management divided by outstanding number of folios, active folios, uh, as of March 20 and as of November 30, right? So 60,000 average ticket size is now grown to 1,21,000 average ticket size, while the exemption limit is close to about 1,50,000. So in last 3-4 years, especially post COVID, investors are actually taking advantage of this category because probably everybody has witnessed the power of equities, the power of compounding, the power of staying put for longer durations, and that has resulted them to make ELSs probably as their first choice. This is what the data is coming out because uh, there may be investors who may be investing more money. It's not that you can only invest up to 1,50,000. You can go as high as much you want. Exemption limits are only available to 1,50,000. So this put into accordance and the lock-in periods in accordance as some of the other products. Clearly, we are seeing investors are choosing this category over some of the other categories.
Hmm. I wonder if this shows that perhaps investors have a bigger risk appetite. Rushabh, what would you say? What kind of investors is this suited for? Because Srinivas has told us that on an average, the amount being invested into ELSS has only grown over the last 3 years. So, what does this say about the risk appetite of investors, and who is this suited for? How does an ELSS investment fare on the risk return meter?
Okay. So as you rightly said, it comprehends to an investor class that is able to associate themselves with equity. And when we say equity, it definitely comes with higher the risk, higher the return. And most of these ELSS funds have exposure up to around 80% towards equity. So being said that, it is very clear that it is not for faint hearted. When you are trying to invest into ELSS, 80% is going to be exposed towards equity, and with equity comes volatility. With volatility comes volatile returns. So whoever can digest that, it's only for them, right? So on riskometer, it is very clear that it is mentioned in the very high risk category. So people who are ready to expose themselves to higher risk. Being said that, it can be mitigated with longer term investment, so they should just increase the time horizon to reduce this risk or volatility in their returns. So that can help them to have an average return of more than inflation, beating inflation, and getting an average return somewhere around 11-12% and above.
So, Srinivasan, how does one increase the time span or the period once it's invested in? Because see, I get X amount as my income, right? And I would like to have the maximum amount in my hand so that I have more disposable income to spend. But then I want to save on tax, so I put away this maximum amount to say 1.5 lakhs. Say I invest entire 1.5 lakhs in ELSS. Now for the next 3 years, I have to put in that 1,50,000 because that's a mandate. You have a 3 year lock-in, means you have to keep that investment. So is 3 years long term, or should I go with that idea that even after 3 years I will do this again and again and again, and over the long term I will get better returns?
Yeah, so that's always a tricky one, right? As to how much time, because we all understand the power of compounding formula. There are three main variables, which is your principal, your rate of return, and then there is time. So time is also a very crucial factor. It's a crucial variable, and the as the time exponentially grows is when the return also sorts of multiplying. So think about it that maybe each year, end of year one, it's a plus return. So whatever is your principal, you add that. Year two, again you add it. Year three, again you add it. But as you start keeping adding that over a period of time, that plus actually becomes X and it starts
Mm.
running, right? And that's how the compounding effect starts coming in. So investors, while we see that, a lot of why do why is this investment value also gone up, and why do investors prefer this category, is because most of the times this is the first entry level product which is sold to any investor coming to mutual funds, because first time whenever he has the disposable income, now he realizes that he's crossed the threshold limit where he will now have to invest somewhere to save tax. Now that's the first time he starts exploring what are the other avenues where he has to invest. And one of those avenues, when he starts exploring, he realizes there's a product like this, which he will be able to buy, he can invest and claim that benefit. And what he realizes one thing after those 3 years, if the first time investor is investing, uh, year one, he's invested 1,50,000. Now that remaining in the markets for 3 years, say say 10% compounding, um, it would result in that value growing to say 1 lakh, between 1 lakh 80 to 2 lakh rupees, right? So when he sees that value at the end of the period, he would look at it and he would say that, look, this is what I have got out of it. And there are many investors who actually then only withdraw 1,50,000 out of those gains and redeploy for the next tax saving after 3 years. As a result of which, it just goes on and on investing. But is it necessary that you should redeem after 3 years and come back? If you're going to come back to the same product, I don't see any sense why you're doing that. You can just continue, because after 3 years, it's a exit load free window. So it's a mandatory lock-in anyways. So after 3 years and one day, you're free, right? You can start withdrawing the money. Yes, it will put a constraint on your ability to liquidate in case of crisis. But if you do any other investment to take the tax benefit, then your other options are 5 years, 7 years, 8 years, right? So with
So,
a tax
Srinivasan,
benefit,
you would say this is the most liquid option available for people wanting to save tax and get good returns?
the only difference is in the other two, there is a withdrawal option available, but then you will lose your exemption, what you had. So if you would have claimed that exemption, you
Mm.
would lose that and you will have to probably refile. I mean, a chartered accountant would give that more
Mm.
clarity. You have to then again go back and refile your returns, because you would have claimed this exemption. And
Mhm.
if your minimum limits are not completed, then that would be a challenge. So here there is a mandatory lock-in. You cannot redeem because it's an investment product. But considering only the exemption part of it, this probably is the lowest uh, lock-in period that you
Lock-in
have.
period. All right. Rushabh, there are two ways by which you can invest in ELSS funds. Either you keep putting small amounts every month by signing into a SIP, or a lump sum at one go. Now, usually, what I have seen is that people closer to March 31st realize, oh, I haven't done the investments I have to, and just one go, let's put this money in ELSS. Is this the more popular way to do it, or does it make more sense to do every month investment via SIP in an ELSS fund?
So, as Mr. Srinivasan rightly suggested, right? So, ELSS is the most favorite option for anybody who's trying to expose themselves to the mutual funds for the first time. And hence, the right approach will be SIP, right? SIP brings in financial discipline. They don't have to remember it. Once it is started, it is ongoing, automatically deducted from their account. So they don't have to worry about the last moment rush, and whether there is savings or not at the last moment in March to deploy an entire 1,50,000 towards ELSS. So it definitely brings in financial discipline. But with that, it also help you with rupee cost averaging. You don't have to worry about whether markets are up or down. You don't have to look at what level you are entering at. It just helps you focus on your work, your job, simultaneously make sure that your investments are done and your savings are being taken care of. Being said that, lump sum is also very important in terms of, let's say, in a scenario where markets have fallen down or crashed. Lump sums can act as rocket boosters for your portfolio. So at that time, I will definitely suggest to deploy whatever is remaining in terms of ELSS, and then make sure that the portfolio is boosted with great returns. So for me, both are important. But being said that, for a first time investor, ELSS through SIP is a better route.
So could you break it down for us, Rishabh? How do I plan it? Say for the entire year, I want to put an X amount. So should I divide that X amount by 12 and set a mandate, a monthly mandate for that amount and go like that? How should I calculate it? I mean,
So
how do I go backwards?
that will be the best way front. So if you know your tax liability for the year, and if you can divide it by 12, that's the right approach. Generally it comes to somewhere around 12,500 if you want to deploy the entire 1.5 lakh towards your tax saving. So that's the right approach to have. Being said that, a lot of people also prefer to do a little bit less. So let's say around 5,000 or 10,000, because they also have some term plans going on. They also have some other kind of, savings that can be used as ATC, which only a CA or a chartered can help you with at the end of the year. So
Mm.
instead of capping out the whole ATC under one asset class, if you prefer to diversify it, then it's always better to do a little bit lesser in amount. And then again, you can, as I said, you can always do a lump sum, if you want to match up the whole 1.5 into ELSS. So that will be my approach towards it.
All right.
Nisha,
Srinivasan.
can I just add on? Just can I add
Yeah,
on?
yeah,
Just
please.
Yeah, sure.
Please go ahead, Srinivas.
um, see, SIP is a cash flow issue
Mm.
where the salaried individual is going to get a salary every month, and from that he can start deploying certain amount. Not like what Rushabh mentioned is right, that not everybody will have that corpus, especially if he's starting out at one go to sort of deploy, because there will be other liabilities and other monthly payouts which is going to keep happening over a period of time. So I think what his suggestion is bang on, that if you start on the SIP right from say April onwards, then you don't have to worry in January, February, March that where I'm going to do the shortfall. And again, on the second point, if it's a salaried individual, then a percentage of ATC would already been taken care of uh, as a part of the salary, of which there is a deployment which is happening to your long-term savings. So generally, it will not be 1,50,000 for
Yeah.
everyone. You're free not to claim that and claim 150 here. So people can do that.
All right. Srinivas, what are the risks associated with an investment in ELSs that one should know about? Is there a downside?
Yes, absolutely, there is a downside, and there is no return without the risk of having a downside. I mean, that is the first
So you're saying
principle
there's
of.
a risk of a downside, but not necessarily a downside.
Not necessarily a big downside. Of course, there will always be volatility. There will always be
Mm,
periods where your returns could be muted, and we've seen that. So,
mm,
for example, in 2016 till 2000, sorry, 2006 to 2009 as a period where we had the
mm,
global financial crisis. If somebody had invested in 2006, markets were on an onward
mm,
journey, then you had a steep, sharp correction. So you had a muted return, which is about 4-5%, which was very less as compared to what the general category has delivered over 3-year rolling periods, right? Again, in during if your period ended in say 2020 of March, then you would have seen a downward return, right? So if somebody came in 2018 and 20, but largely by extending your periods by another 1 year, market generally sort of rebound. right? So element of risk will always be there with equity, but it's your best option to be in the market. And one of the things which works in favor of ELSS as compared to other categories is the behavioral aspect, because the day you see your NAVs every day, you see volatility every day, you see markets up and down every day. Here Rushabh deals with a lot of investors, so he can also bring his side here. But we generally see that investors get very panicked with large amounts of volatility. But I must also confess that we are seeing a very matured investor base now over the last developing over the last few years, where the SIP data at the industry level is also showcasing how investors are participating at all levels, right? So the behavioral aspect kicks in, where he's now that he knows that 3 year is a lock-in, all he can do is watch but not do anything, right? He cannot come out, he cannot redeem, he cannot meet any immediate expenses coming out of that pool of money that he's invested already in locked. So end of 3 years, he does see a decent return in his hand, and that is something which brings investors back. And ELSS will always be a stepping stone, that they come in, they experience this, and as they go up, they realize that okay, now there are more categories, and they start exploring the other MF categories. Please remember, market cycles generally last 4 years. You make money in about 1.5 to 2 years, but which one it is, you don't know. You can either see it early, you can see it in mid phase, or you can see it late, right? So any investors who have come in, say some investor came in April 2020 and invested in the first year, he would have seen super phenomenal returns, but
Mhm.
last year he may not have seen that return, right? Again, if somebody has come in the last 2 months, he would have seen a very different picture with market rallying, but not necessary if he would have come last year sometime, right? So you will have different phases, but what a lock-in product does is controls your behavior, and I think that is one of the other positive sides of this category.
Right. Rishabh, when you can't do anything, so I guess you just control your behavior, right? 3 years, you're locked in. But in your anecdotal experience, what you have seen with your clients, do clients who have other mutual funds get panicky when the markets start to, crash or move down? And do they then make bad decisions? So you have a lock-in, and perhaps you did make that bad decision because no one can time the market, right? If in the long term you stay put, you make the money. But most people who have mutual funds, which are not these lock-in ones, will get out at the first sign of anxiety or first sign of crash, right? What have you seen with your clients on a day-to-day basis?
So on a day-to-day basis, as you rightly said, it's the herd mentality that comes into act when markets are crashing or markets are about the all-time highs, right? So definitely, financial behavior plays a major role over here, and I believe that is where we as advisors also have a major role to play, because we are the autocorrect mode that they are using at those extreme ends, because money is nothing but emotion, right? So to control those emotions at those particular times is the most crucial thing about the investment cycle, because if you panic and exit at the bottom, and if you get all excited at the top, I'm sure that's definitely not going to make you a lot of money, right? So ELSS hence helps in a great way to give them a starter, where they are locked in for 3 years, as we all understand that you can't do anything but just observe and learn the market. So I believe that's the most important lesson that this product offers to all the investors.
And of course, the power of compounding. If you stay for long enough, you see your money multiply. I think that is also a message that comes across with ELSS, that you save the tax and you see your money grow. Thank you, Rushabh and Srinivas, for joining us. and talking to us about ELSS. This brings us to the end of today's discussions. Thank you both for joining us and sharing your insights. Thank you, viewers, for joining in for this session as well. I trust you have found it to be informative and empowering. Before we sign off, I would like to thank Mirae Asset Mutual Fund for partnering with us for today's session. We will be back soon with yet another discussion on smart investing very soon. Till then, stay well and take care.
Thank you.
Thank you.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully.
Thank you.